Hey, good morning, options traders. Welcome back, everyone, and a very big welcome to the new traders that we've had here recently. It's great having you here. And a question I used to like to ask my class all the time was a really memorable scene, at least for the options traders, from the movie Wall Street, and how the Wall Street warrior himself, Gordon Gekko, actually got it wrong. And the reason I like to show this is not so much just to point out a mistake, but is to learn from it. And the thing that I want you to learn from this video is the importance of understanding your options theory, and in this case, put-call parity. Too many times traders say, you don't need that stuff. That's just theory. Well, let me show you where it could have really paid off big. Now, the scene I'm talking about, of course, is with Anacott Steel. And if you remember in that scene, Gordon Gekko has found out that Anacott Steel is going to have some positive news coming out that's going to most likely cause a big rise in the stock's price. And then he instructed his broker, Bud Fox, to buy 1,500 July 50 calls. And then he said, start buying in 1,000 share blocks and take it up to $50, talking about the underlying stock, of course. And then he said, when it reaches 50, start giving a little taste to your friends, meaning to the other brokers in there. They'll start promoting it to all of their clients. It'll push these calls well into the money. Classic insider trading scheme. But because it was inside information, how could he have improved this trade? And this is where your theory comes into play with put-call parity. Now, I'm not talking about using your theory to use trade on inside information or do anything illegal, but I'm just showing you how, based on a given set of information, you can make better decisions. So recall from previous videos, got lots of them in here on put-call parity. It's a mathematical formula from which our synthetics comes from, but the basic form of it, or at least one form, is to say that long shares of stock plus a put minus a call, assuming the call and the put are the same strike, will in fact equal a bond. So in a lot of ways it behaves like a T-bill. You might pay, let's say, $95 and it'll be guaranteed to mature to $100. That's how a T-bill works. And the combination of a stock and a long put and a short call will do just that. This is a trade called a conversion, and it's quite common among, especially for floor traders, but it's really the basis for put-call parity. So what we're saying here is that stock and a long put, that's what the plus sign is, and a combination of a short call, that's what the minus sign is, equals a long bond. So we can rearrange this formula, just a little bit of algebra here. We're going to solve for a long call. And I can do that by swinging this minus call to the right side of the equal sign, and of course I have to change the sign and then bring the bond over to the left side and change its sign. And so we will get the call option equals long shares of stock plus a short bond and a long put. So what is a short bond? Well, a short bond is something that you have sold and you're going to collect cash. So in this example, if you could buy the bond for 95 and it would mature to 100, you're doing the reverse. You're going to borrow 95 and owe 100. So notice what a call option is when we view it in this form. It is levered stock. Just looking at these two pieces, long stock and a short bond, you are borrowing money, that's the short bond, to buy shares of stock. That's where the leverage comes from. But what about this long put over here? This is an attached insurance policy. It's going to protect you in case you are wrong. If that stock price takes a nosedive, you're not responsible for any of the negative outcomes. So see, this is an important insight from put-call parity. Most people just say, oh, the call option gives you a lot of leverage. And that's true, but it also provides an insurance policy. And people overlook that. So let's rewrite this to say that a call option is the same as levered stock. You can think of that as buying stock on margin plus an insurance policy. Well, now think about it. If you're going to trade on inside information and you know the answer, you know the result, why would you buy an insurance policy in case you're wrong? You wouldn't. You would just want the levered stock. And what is that? Well, the levered stock means we will have to sell out this put, kind of spin it out of this equation. We would buy the call and sell the put. And that's exactly what Gordon Gekko should have done. He should have bought 1,500 of the July 50 calls, but also sold 1,500 of the July 50 puts. That would have given him a delta 1 position, no extrinsic value, and a boatload more leverage, and he would have just been foregoing the insurance policy that he didn't need. But I like to show this because this is a very simple way of saying, let's put some more thought into our strategies. Do we need an insurance policy in this case? And if we don't, how do we spin it out? Are there other ways we could get rid of it? What if we do want the insurance? What if we want more insurance? What if we want it to kick in at different places or at different stock prices? This is where the real art and science of the options trading comes in. So I thought this was just kind of a fun little way to at least show you where all of these theoretical equations and things like put-call parity can actually pay off really, really big, even for an inside trader like Gordon Gekko. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.